Hello and welcome, everybody. Looks like we've got a good batch of people on. Welcome to another Monday night meeting, our monthly meeting with us. I have a few announcements first to kick things off before we get rolling with our guests today. Biggest thing is just calling people's attention to our events calendar. We actually have a really busy week this week, which is great. Tomorrow we've got a lunch and learn that's going to be on the topic of farmlands and investing in farmlands. That'll be interesting. On Wednesday, Rise 48 has a multifamily offering they'll be presenting to the group. On Thursday, Spartan has another fund coming out that they're going to be presenting. So we'll have that for you on Thursday afternoon. And then Friday, Outpost Ventures is going to be presenting a deal related to low risk venture capital business. So something kind of new asset class for us. All of those are this week. They're all around noon Eastern Standard Time. Check the events calendar. You can get specifics on it. Also want to call out this week that in Phoenix, if you're going to the conference or are local to Phoenix, there is going to be some get-togethers with the Rise 48 team and Left Field. There is another email coming out from us about RSVPing, so look for that, I think, tomorrow. We would like you to RSVP if you're going to be local and want to attend that. Next week is a big week. We're doing a lot of travel next week as well. There's a family office club meeting to start the week out in LA. And there will be a private lunch for Left Field members. So when you get there, if you're going and you get there and register, mention Left Field and ask about the lunch so you can get tied in with that. Then it's all transitioning to Utah and in Salt Lake City for the IIREC and the BEC. Left Field will be hosting events both Wednesday night and Thursday night. We do ask that you RSVP for those as well. So you'll see emails coming out about that and RSVP links here in the next day or two as well. So lots going on the next couple of weeks, which is great. And we're excited to get out and get some face-to-face time with the community. So hopefully between Phoenix, LA, and Utah, we catch a lot of members in the mix. So we're excited to see people out and about. I think that's all of my announcements. So we will roll things over to the Rise 48 team. Along the way, if you do have any questions, feel free to put them in the chat, or the Q&A is a little easier. Dump them in there and we'll cover them at the end. And outside of that, Zach, we'll turn it over to you, I guess. Appreciate you coming tonight.
Yeah. Thanks so much, Chad and Jim and the entire LFI group for having us. Really appreciate it. And it's kind of funny timing. I know that it was a couple of months ago you guys reached out and offered us the opportunity to have one of your monthly event meetings, and it wasn't until like a week or two ago, Chad, that we decided let's make this the topic. I know Jim kept pinging me like, "Hey, we need your topic," and we were talking about the growth of the company, but it was actually a couple of weeks ago. Some investors started reaching out to us that were our investors, both LFI and non-LFI, just saying, "Hey, we're starting to see capital calls happening around the country with different deals that we're in." And then, shortly after that, I had one investor reach out to me and say, "Hey, Zach, I heard you guys are doing capital calls." And I told him, "No, that's absolutely not true. Where did you hear that?" And then shortly after, I know LFI did a webinar with a group talking about how they're doing, some version of infusion or capital call. And so it was a couple of weeks ago we decided, Bikram and I and Robert at Rise 48, that we need to get out in front of this and do a live webinar for our entire base. And so we actually did like a live webinar 2 weeks ago. We went over the state of the portfolio, and we have over 5,000 investors on our list. And so we offered this live webinar for everybody. We sent out the recording, and, I know we had this coming up, and now we've now done at least, 5 or 6 deals, with LFI. And we really appreciate the partnership. And we have a lot of LFI investors, a lot of money that's been invested through the group into our deals. And so we figure this is actually a very relevant time and a relevant topic to take you through the state of our portfolio and the things that we've been doing, historically and currently now, and kind of show you why we're in good shape, like why we don't have any concerns of doing any capital calls and any deals this year or in 2024. Okay. And we've never done a capital call, and we'll show you kind of the things that we've done. And so, we felt that it was really relevant, and it is kind of coincidence that we also are going to be doing a live webinar Wednesday with LFI for a new Dallas deal. And then we also have the in-person meetup, which is actually going to be here. Becker and I are both at our office right now. So we're happy to, see everybody who can make that live meetup in Phoenix Thursday this week. So with that said, we'll kind of want to jump into this. So I'm going to go through the state of our portfolio, and you see the agenda for our presentation. This is not meant to be some very long drawn out presentation, like a webinar for a deal, but we do have specific points that we want to, really go over and go in depth. So I don't have a ton of slides, but I think we'll be very, detailed as we go through these slides and just show you, the way that we look at these deals. And then we want to make sure we leave it open for questions for as long as we need to, for as many questions as there are. And so talk about state of the portfolio. We'll go over renovations, case studies, and then what is our 2023 outlook for buying and selling? What is our philosophy? Why are we still going after deals? And how long is it going to take to sell deals that we've already purchased? And to give everybody an idea, I know that we have people who have been in LFI that were actually, some people were already investors with us, since 2019. But we did our first formal deal with LFI last year in 2022. Okay. So anybody who's been investing through the LFI group started in 2022 deals, but we do have other investors that were with us and also happen to be in LFI. But with that said, so the biggest thing we want people to know is we have never done a capital call. Okay. And we do not plan to do any capital calls on a single asset in the portfolio in all of 2023 or 2024. Okay. And some of the main reasons for that, as you can see here, is we've always taken lower leverage on our deals. We've always been a 60 to 70% loan to value type of group, even when interest rates were low and you could get 80 to 85% leverage. Okay. We have a few deals. The highest leverage we ever took was 75% loan to value. Okay. So the majority of our deals, we have 30 to 40% cash down payment. And I'm talking about, even when rates were low, 2020, 2021, we took low leverage. A lot of the groups that are in trouble right now took high leverage. They took 80% or more, so they have very high debt service payments. So we've always been a lower leverage group. We've always purchased 3-year interest rate caps on every single deal. Okay. The interest rate cap is something that you purchase where your interest rate cannot exceed that cap, no matter what happens in the world with the Fed, the treasuries, et cetera. And so, a lot of groups the last few years have bought 1 or 2 year caps. And so, some of you who may be in deals who are experiencing capital calls, we have investors that have reached out to us. So this is not speculation. We know for a fact there's groups right now doing capital calls, and our investors are telling us because they're in these deals. And a lot of them are saying it's because the interest rate cap for that deal is expiring this year. And so the sponsors are needing an infusion of capital in order to buy this new cap for the interest rate. They don't have the cash reserves at the property, okay? Because they didn't buy a long enough cap. If you bought a 1 or 2 year cap the last 2 years, it's going to be expiring. So that's a big problem for people right now. We've always bought 3-year caps. We've sold 11 deals since we've started. We bought 40, we've sold 11. And the longest deal that we've owned, that we currently still own, we bought it in June of 2021. And so that 3-year cap will not expire until June of 2024. Okay. So we have plenty of runway there. And we'll talk about our strategy, before we even get close to those caps coming up that were 2021 acquisitions. And then you see here, we've always raised significant cash reserves on the front end of every acquisition. Okay. So ever since day one, we've intentionally overcapitalized deals. We raise additional cash reserves, which is just liquid rainy day cash, separate from CapEx, separate from interest rate reserves, just so that there's additional liquidity at the asset level. Okay. And that's been critical. Most groups have not done this. And it's kind of funny, even a couple of years ago, it was very, very few and rare, but every now and then we get investors that would criticize us and say, hey, I don't like how you're raising all this extra cash because you're diluting investor returns, overcapitalizing the deal. And we would just say, well, that's how we underwrite deals. If you don't like it, then you probably shouldn't invest with us. And now that's one of the main reasons why we're in good shape. Okay. Because what's happened with a lot of people is their debt service has just shot up so quickly. And we'll go more into this on some other slides, but their debt service has shot up so quickly that they're negatively cash flowing. The NOI, has the debt service is here, NOI is here. Well, debt service shot up and NOI cannot catch up fast enough. So you don't have enough cash to absorb that difference in the meantime. That's why people are in trouble. Okay. So these are really the big three reasons why, we're in good shape. And And I can't paint a broad brush and speak to everybody across the country, all these sponsors. But these are the three biggest things that, you may not be doing one or all of these if you're in trouble right now. Another big component that we're going to focus on is the fact that we are vertically integrated. We have our own property management company that we started. We do all the property management in-house, construction management in-house, and we have full control over our supply chain. Okay, so this makes a big difference right now because the days of organic rent growth are gone. Okay, and that's in Phoenix, Dallas, all the biggest markets across the country. Organic rent growth has decelerated and normalized significantly, really starting Q2 of last year after that post-COVID surge, really slowed down. And so the ability to have sound operations and have full control of these assets is very critical. And I'm not saying that people with third-party management can't do well. I'm not saying that. I'm just saying that, in the markets that we're in for what we need to do, we've noticed it makes a big difference because we used to use third-party management. Okay, so we've seen the differences. And then we'll focus on the fact that, we're exceeding our projected rents upon renovations across all these units that we're renovating. Okay, so we're still forcing appreciation by renovating units on schedule, on budget, providing a higher quality product. We don't have to rely on organic appreciation. See, these are some of the main points here, and we're going to dive deeper into these now. And I'll chime Bikram in here too, to kind of speak to some of these points. And so, the first point of these three that we were talking about, cash reserve and stress tests. Okay, so this may seem kind of ridiculous, but we're just trying to very clearly put no capital calls at the top. Okay, because again, we take great pride in our operations. And I had somebody reach out a couple of weeks ago saying, I heard you guys doing capital calls. I was honestly upset. I was frustrated. I said, no, who is it? I said, tell me who it is. That's defamation. We don't want people to think we're doing capital calls. We don't want to be grouped in with these other sponsors that are doing that, because a capital call is like career suicide. Okay, it's like a black mark on your reputation as a sponsor. Investors do not want to have to put in more money after they've already made an initial investment with what they thought was a conservative investment. Okay, and so this is like the worst case scenario if you have to do a capital call, and we're not even close to that. And so we'll focus on the cash reserves. Okay, so like I was saying, what's happened with a lot of these deals, okay, the way that people have structured these deals, most of the value add multifamily the last few years has been floating rate debt. Okay, and I'll go into why we still think floating rate debt is good. Okay, and how we mitigate against it, as opposed to fixed rate debt, and I'll go into that. But most people have taken highly leveraged floating rate debt. Okay, which means that your interest rate, your interest rate is comprised of two things, really. Okay, it's your lender spread. Okay, the spread from the lender is a fixed margin. That's their profit margin. And that spread is going to float over an index. And for most of these deals, these commercial deals, it's the SOFR index. There's a direct correlation between the Fed funds rate, which is what the Fed has been increasing over 450 basis points since last March of 2022. There's a direct correlation between the Fed funds rate and the SOFR, okay, the SOFR index. As the Fed continues to raise the Fed fund rate, SOFR increases. And so this spread that the lender has is floating over SOFR. And as SOFR goes up, your all-in interest rate keeps going up. Okay, so when people are modeling these deals, they're buying an interest rate cap up here. Okay, and then they're projecting that their NOI is right here, and it's going to stay above the interest rate. Okay, and to the credit of the sponsors across the country, this is not to bash everybody and say we're smarter than everybody, because we're not. Nobody saw interest rates going up this quickly, even the biggest institutions in the country. Okay, I was at, Bikram and I were at a private equity conference in January, IMN in Laguna. And I spoke on a few panels with the biggest private equity groups in the country. I was on a panel with Blackstone and these other massive REITs. And I talked to a bunch of guys at this equity conference, and they're like, yeah, we're all doing capital calls. And these are supposed to be the biggest, smartest institutions in the country that have, supposedly inside information. The difference is that you don't hear about it with them because they're extremely well capitalized. They're just going to infuse more money into the deal to meet the needs. Whereas, syndications with retail investors, hundreds of everyday people, if you do a capital call, they get pissed off, right? They don't want to put more money in. And so this is happening across the country. Okay, so what people were projecting is your interest rate cap is up here, and the forward-looking curve did not project interest rates to increase like this at all. Okay, this is the most significant and fastest increase in interest rates in this short amount of a time since the 1980s. Okay, going up 450 basis points, or more than 4.5% in about 12 months or less. So people said their NOI is here, interest rates are here, I'm just going to continue to increase NOI, my interest rate stays below that. Well, what happened in reality is your interest rate shot up to the cap. Okay, above your revenue, your NOI. So now you're negatively cash flowing. If you don't have cash reserves in place, at the property level, then you're in trouble because you don't have liquidity at the property. You can't pay the expenses. You can't even pay your lender. You can't pay the debt. Okay. And so that's what's happening. That's why people, are starting to do capital calls, and you're just now starting to see it happen. We think you're going to start to see a lot more distress in the next several months, across the country, mostly with these syndications of retail investors, because they don't have the ability to infuse a lot more capital like the big private equity groups do. Okay. So the good thing for us is that we've always raised significant cash reserves. We have a handful of properties right now that in the short term are negatively cash flowing because debt service shot up so quickly, but we have so much cash at the property level that we're in good shape, and we're still increasing NOI and we're closing the gap. Okay. And so what we're doing, we started doing this the summer of last year. We started doing these monthly stress tests. And so at Rise 48, to Bikron's credit, and I'll chime you in here, Bikron, to speak about this shortly. Bikron has built out a full FP&A department, which is a financial planning and analysis department. So we've got 5 guys who are just full-time analysts. And basically every month what they're doing is they're taking a stress test for every single property, and they're assuming the max interest rate for the next 36 months. And then they're shaving down the NOI growth significantly, even from what it was initially. And the whole point of the test is to see, do we run out of cash at the property to have to infuse capital to a cash call? And we don't run out of cash on any of these properties. That's why we can comfortably say we don't plan to do any capital calls in 2023 or 2024. Okay. And so a big part of that is raising cash reserves on the front end and keeping it in the property level account. And Bikron, do you kind of want to speak more to the stress test that you guys are doing and the different analyses that you guys are doing to make sure we're in a good shape here?
Yeah, of course. So from a stress test perspective, just a little background, the way these value add multifamily deals work is that you have a deal where, you're going to go in and renovate the units, take care of deferred maintenance, do some marketing upgrades, and really kind of boost the NOI. Over the first 3 years of the business plan execution, you're really looking at boosting NOI anywhere between 30 to 60%, sometimes even 50, 60, 70% on these deals. So that's really the thesis behind value add multifamily. You're forcing NOI increase and therefore forcing capital transaction increase. So on our end, in order to make sure that we have an ample cash supply on the deal level, what we do is we trail back the NOI increase. Instead of it being 60% in the first 3 years, we're really narrowing it down to just 1 to 2% per month on the deal level. And then we're boosting up the total loan amount, interest rate, and the total amount up to the maximum amount to see, okay, well, in the worst case scenario, say NOI increases 1 to 2% a month, as opposed to, increasing 20% in the year, and your loan interest payments are at their maximum level for the next 3 years. Are we in a situation at any point for any of the deals where we run out of cash and we have to do a capital call? And none of the deals that we have under management are in that scenario at all. There are, as Zach mentioned, deals that are negatively cash flowing, but with our renovation strategy that we have and turning these units and renting them out at a higher rental rates, we eventually catch up on all these deals to positively cash flow with the maximum interest rate and with a depleted NOI. So that's really how kind of the stress test works.
Yeah, no, thanks for that explanation, Bikram. And I guess I didn't really introduce you. I kind of didn't think about it. So for all the LFI webinars that we've done, I've pretty much led those webinars myself. But typically, like for our main webinar that we send out to our investor base that's recorded, it's typically Bikram, Robert, and I. So Bikram is our CFO. Bikram, Robert, myself, founded the company. Bikram has an economics degree. He's a CPA. He worked at PricewaterhouseCoopers for a number of years as a corporate auditor, auditing Fortune 100 companies. So Bikram is really, overseeing all these back-end processes and really deserves a lot of the credit just for building out the company in general. And so him and I, are meeting every single night going through the portfolio after the day is over. And so can you use some background into what we're doing with those stress tests? The next point we talked about is these interest rate caps. Okay. And so, like I said, when you have floating rate debt, most lenders require that you buy an interest rate cap, okay, on your loan. Okay. And so, but they don't require how long the cap is. And so the last few years, interest rates, again, were not projected to go up. And everybody references like Chatham Financial and these forward-looking interest rate curves, like they're the Bible, like they basically, never are wrong. And they were all completely wrong. okay, at the end of last year, and even beginning of end of 2021, beginning of 2022. And so, what we've always done since day one is we've always purchased 3-year caps. Okay, meaning that no matter what happens in the world with the Fed, the index, the Treasury, the interest rate cannot go higher than that cap. Okay, which means that we're protected, and that we can truly should project out a worst case scenario for the next 3 years. Where is that interest rate cap going to be? And so, like we mentioned earlier, we've sold 11 deals. The oldest property that we currently have in our portfolio, we purchased in June of 2021, which means that cap doesn't expire until June of 2024. Okay, so people are probably thinking, well, what are you going to do, once that cap comes up? And so, we have almost 18 months right now until some of those caps that we purchased in summer of 2021 and later start to expire. Okay, and so basically the plan is, and we'll talk more about this on some upcoming slides here, but the plan across the portfolio is to increase the velocity of renovations so that we can maximize NOI, so that even if rates don't come down, and by the way, we don't think rates will come down this year. I think they'll come down next year, but we're not counting on that in any of these stress tests. We don't count them coming down for 3 years in the model. But the whole plan is renovate, most of these units so that we can maximize the NOI, so that even if rates don't come down, when you've maximized NOI or you've increased NOI, you qualify for more loan proceeds. So you can refinance out of the initial loan. We would refi into like a 10-year Freddie Mac loan which is another floating rate. And you can use the proceeds of your new loan to buy a new 3-year interest rate cap. Okay, so the plan is for 2021 deals, that were purchased in summer of 2021, we're cranking through renovations. We're cranking through renovations across the portfolio, but we're really prioritizing those ones because by the end of this year, early Q1 of 2024, we're going to have done 90 to 100% of the units renovated so that we've maximized NOI to qualify for a new loan, which will pay off the first loan, take that out, and then get another 3-year interest rate cap. Okay, and so that's kind of the strategy here. And to give you guys an idea, we just renovated 240 units just in February. Okay, we were doing like 50 to 100 units per month in 2022, and we weren't going full speed because in our model, ever since we started the company, it's always been a 5-year stress test for every deal. We assume that we're going to buy a deal, that there's immediately going to be a recession. We're going to hold through the recession, renovate 100% of the units, and sell in year 5 to achieve the returns we're projecting to investors. That's how the model has always been ever since day one. In reality, the last several years, we'll buy a deal, and because the market's been strong, we'll crank through 20 to 50% of the interiors like in the first 12 months, and we hit the brakes. We stop renovating on purpose, and we leave additional classic units or value add available for the next seller, because we've already proven out the concept and we've shown, hey, Mr. Buyer, I'm sorry, the next buyer, not the next seller. Mr. Buyer, hey, I've renovated half of these properties. I've gotten a $300 rent bump. You can just continue this business plan. It allows us to sell the deal at a lower cap rate, get out of the deal faster, and hit a home run for investors. Okay, that's what we've been doing in reality. Okay, well, now we're putting the stress test to the test, so to speak, where we're actually renovating all of these units. So we're increasing the velocity of renovations so that we can qualify for more loan proceeds, even if rates don't come down, and buy another low cap. And some people may be asking, well, wait a second, what if next summer rates are still higher, they're higher than they are now, how are you going to refi? And how are you going to get a cap? Because the cap's going to be so high. Well, the whole purpose of these interest rate caps is that you can buy a cap that's much lower than what interest rates are currently at. Okay, so when you buy an interest rate cap, to give people an idea, it's similar to when you buy a single family home, how you can prepay the interest on the front end. Okay, we're effectively prepaying interest and buying down the interest rate. So there's a couple offerings that we've launched recently, which LFI has seen, where we're buying an interest rate cap for the first few years at between 4.75 to 5%. Like this deal we're going to launch in Dallas this week, it's a 5% max rate for the first 3 years. If we didn't have a cap, that rate is more like around 8%. Okay, but we're basically buying down that interest rate. And so we can do the same thing next year. You maximize NOI, you qualify for more loan proceeds to pay off the first loan. You can use loan proceeds of your new loan to buy a new interest rate cap, and you can buy that interest rate down. Okay, so that's kind of the strategy here in regards to interest rate caps and how those work. And then the third thing we talked about, is increasing the velocity of renovations, which we've really talked about, so that we maximize NOI and we have enough proceeds to take out the first loan and buy a new interest rate cap. And so here you can kind of see, a summary of, what we're doing with renovations and things like that. And so if you see here, a couple things that make us unique in both the Phoenix and the Dallas markets is our operational infrastructure. Okay. And so, we have the property management in-house, we have the construction management in-house, but one thing that's very unique that most people don't do is that we buy all of our materials directly wholesale, directly from an overseas manufacturer. Okay. So our manufacturer has plants in Taiwan, Malaysia, Shanghai, and Vietnam. So basically they're manufacturing everything inside the unit, everything except the adhesive for the vinyl plank flooring, and they use a third party for the appliances, but we still buy the appliances through them. Most of our competition for 1980s workforce housing is basically doing resurfaced countertops. They're painting the original cabinets, doing black appliances. It's lipstick on a pig, and which is fine. That's the typical value add for workforce housing. We used to do the same scope, okay, because that's all that you could afford for it to pencil. It didn't make sense to do these very high-end level finishes that we've been doing the last couple of years. But once we started buying wholesale and we started controlling our supply chain, we've been getting very, low wholesale costs to where we're going into these units and we're stripping down the entire unit to the stud. We rip out the entire unit and it's a brand new unit with quartz countertops, undermount sinks, modern plumbing pull-down fixtures, stainless steel appliances, subway tile backsplash. So we've renovated over 1,000+ units that look exactly like this the last couple of years. So we truly do have a higher level interior finish than like 95% of our competition in both Dallas and Phoenix, okay, for the value add. And then we can get it at a much cheaper price. And our manufacturer has warehouses in both Dallas and Phoenix. Okay, and that was one of the major reasons we went to Dallas, is because it's the same exact supply chain. We have the exact same pricing, same logistics process. The owner of our manufacturer is actually a big investor with us. He was a friend of ours. Bikram and I were out there in December touring the warehouse. And so this gives us, a lot of control. We can control our pricing. And then we have a lot of infrastructure and bandwidth for labor. Like I said, I have no doubt. I mean, I don't have data to support this. I don't think anybody tracks it, but I have no doubt that we're probably renovating more units than anybody in the state of Arizona per month right now. We just did 240 units just in February. We're doing another 200 units in March, and it's just like an assembly line. Okay, we just drop these pallets. We drop 2 pallets into every unit, and our guys go in and unwrap the pallet, and has everything custom measured and cut for that unit. So it has prefabricated countertops, quartz countertops, exactly measured for that. It has all the vinyl plank flooring already cut and measured. It has fully assembled cabinet boxes, all the hardware, everything in this unit. You see, even the toilets, it's all coming on 2 pallets, and we just kind of crank through it. So we have a lot of infrastructure there because, like I was saying earlier, for those of you who joined late, the days of relying on organic rent growth are over. Okay, the last 5 to 7 years, anybody could go buy a deal, call it value add. You just buy a deal, you wait 2 or 3 years, you don't do anything to it. And because the organic rent growth has been so strong and the cap rates have compressed, you can sell the deal and you look like a genius. You get a strong return, right? And we've been benefactors of that too, no doubt. It's a strong market, makes everybody look smart, right? But we've been fortunate to be able to build out true infrastructure. We can renovate units on schedule and on budget, provide a higher quality level interior finish, and truly force the appreciation. Okay, because you can't rely on organic rent growth anymore to cover up your operational blemishes. You have to provide a higher quality product to push the rent. And people are still willing to pay more for a higher quality interior finish. Okay, like we have over 5,500 units right now in Phoenix. Our average rent is between $1,200 to $1,300 a month. Okay, and we've renovated a lot of those. And so it's still affordable. And what we're starting to see now is we're starting to see those Class A tenants that are paying $2,500, $3,000 plus a month in those Class A luxury apartments. Well, inflation has caught up to them. Okay, their daily living costs have been so high for so long. They're now starting to trickle down into our B space because they still get all the same interior finishes. They don't get all the sexy modern amenities of a Class A apartment, but it's a lot more affordable. Okay, and it's still a nice scope. And then you see those Class C tenants, they get better jobs and want to move up into this higher level scope. They can afford it. Okay, so this is where we want to be. And if anything, the last couple of years have validated our approach to just sticking to what we know, in this workforce housing type of space. And so this kind of gives you an idea of why we feel good. And to kind of expand on this, we wanted to show you actual renovations case studies, okay, of how we're renovating these units on schedule and on budget. So some of you may have seen these next 2 slides from like our individual deal decks, but this kind of puts in a different perspective of why it's so critical right now. Okay, so this is 2021 acquisitions. This is 15 different properties. So each one of these two lines is one property. Okay, as you can see at the bottom, the striped bar represents the projected pro forma rent that we were projecting to hit before we bought the deal. Okay, the solid blue line represents the actual rents we were achieving after we bought the deal, renovated the units, and leased it up. And so every single deal here, as you can see across the 15, we not only met, but we exceeded our pro forma rent by an average of $73 per unit. Okay, and this is critical when you're trying to achieve a business plan. This was over 400 plus units. And you can see here, the first 5 of these, we already sold them. We bought them in the beginning half of 2021. These were all home runs for investors. Okay, and we 1031 exchanged all 5 of these deals. And the biggest reason we were able to sell these things so quickly is because we exceeded our pro forma rents. Okay, so we collapsed the time frame. We accelerated that NOI growth, so it was worth more. Okay, and some of you might be thinking, well, okay, that's great. 2021, the market was really strong. People were probably exceeding their pro forma rents. Well, 2022, organic rent growth decelerated across the country significantly. We renovated even more units in 2022, over 600 plus units last year. And again, we weren't even going full speed to our complete operational bandwidth because, we were still kind of, trying to see where rates were going. This is 11 different assets that we purchased. And you see here for every single deal, we not only met, we exceeded the projected rents by an average of $48 per unit. We've renovated over 1,000 units the last 24 months. And so, this is going to be critical going forward where, the superior operators are going to separate themselves the next few years by being able to actually add value for a value add plan. You have to actually be able to renovate these units on schedule, on budget, and force the appreciation to hit these rents. And it's a lot tougher than people think. I think that a lot of people who look at different sponsors throughout the country and have had good returns, ask them how many units have they actually renovated. Okay. And what is that level of scope? A lot of it's just been organic rent growth and being in a strong market. But when you're in a recessionary period like this, where you have high interest rates, organic rent growth is really decelerating, you have to be able to have high NOI. Okay. Being able to increase your NOI is your ultimate insulator. Okay. And that, because like I said, if you can increase your NOI, even if rates stay the same or go a little bit higher, you can qualify for more loan proceeds and refinance, and you have flexibility there. Okay. So this is a big, critical piece going forward, no doubt. Bikram, did you have anything to add to that, just in regards to kind of like how we're increasing velocity and changing the business plan, NOI growth, things like that?
Yeah, I mean, I can just chime in a little bit. So with regards to our renovation strategy, we always assume in the model itself, they're going to renovate 100% of the property anyways, and then refinance after we're done renovating and stabilizing the NOI. So there's really no change in terms of how we're going about our business plan. We're not shifting it completely to something else. We're not, putting in new amenities that we never even thought of in the beginning. It's always been about, hey, we're going to go in, renovate, stabilize, refinance, and then sell after a few years. Over the past few years, it's just the market's been so great. We've been able to get through 30-40% in renovations and sell the asset. In the next few years, it's going to be more likely that we renovate the property more so and then sell it after year 4, year 5, as opposed to after 2 years to get that equity multiple that we want to get for the investors.
Yeah, it's a great question. Yeah, I think that's a great point. It's not that we haven't budgeted for this, right? So on the front end, we've always assumed, like Bikram said, we're going to renovate 100% of the units. So like our CapEx budgets, everything, the deal has always been underwritten and built for that. It's just that in the past, we haven't had to do all of the units in order to get a strong return. And now, we think that it's necessary. I mean, things could change next year, rates could come back down, but as it stands right now, we're just cranking through these renovations to really, maximize NOI and get through these units. And yeah, I mean, to give people an idea, we've gone full cycle and sold 11 assets so far since we've started. We've averaged to more than double investor money in about 18 months across those 11 deals. And, I've been telling investors, the last 6 to 9 months, that's not realistic anymore. I'm not going to double your money in 12 to 24 months. We do think that it's possible to hit a 1.2 to 2x in 3 to 4 years. We definitely still think that it's very realistic, and we feel confident we'll hit our 5-year projections on all of these deals. And even deals that we bought in 2021, we feel really good about those deals. It's just that, when you have 2 factors that have really happened that slows down the velocity of these sales. Okay. One is interest rates have gone up, so your debt is more expensive. And the second thing is organic rent growth has started to slow down. So because of those two factors, it takes a little bit longer to hit your target exit valuation, to hit the target return for investors. Okay. And so I think we'll touch base on that too, like on this, when we're talking about outlook for selling. So that kind of just shows you guys, like, what our plan is. My video turned off for some reason. Okay. That just shows you guys, how we've always structured these deals in the past, why we're in good shape now. Now we're continuing to do that. And the fact that we're not doing any capital calls on any deals. Now we kind of want to go through our 2023 outlook for buying and selling, and kind of give you guys some insight there. And so, right now the values are down, 15 to up to 25% on some of these deals from where they were just in Q2 of last year. Okay. And so you can get these deals at a really good basis. And so, I know some people might think, you're crazy for buying deals right now. There's a lot of volatility. Well, we actually think that this is a very opportune time. Okay. And we'll give you an example. During COVID in 2020, we were already active and established in 2020, and we were freaking out during COVID, just like everybody else, for those first few months. Like, what's going to happen? Well, then the summer comes around, June, July, and we're looking at our portfolio and we're like, okay, everything's still performing. I think we should probably start going after some deals. So the second half of 2020, we got a handful, I think 3 or 4 off-market deals under contract that all started to close in 2021. And we got them at a great basis, and they were all home runs for investors. The last 5 to 7 years, I've talked to so many investors and people who want to be sponsors who have said, oh, the market's overheated. We're at the top of the cycle. I'm waiting for a recession, to get more discounts and get the pricing right. Well, the recession is here. Okay. Like 15 to 25% discount is pretty significant. There's not a lot of competition right now. Most of these private equity groups are just on the sidelines because of all the volatility with the interest rates. Okay. What we think is going to happen, and again, we don't know what will happen with rates. Okay. But a lot of people are projecting the Fed will do 1 to 2 more 25 basis point increases, and that, maybe around the summertime, they'll plateau and they'll stop. Okay. The reason most of the private equity groups right now are on the sidelines is because of the uncertainty and the volatility with potential future expected rate hikes. Once we've hit a ceiling, 2 things are going to happen. Okay. One, the private equity groups are already behind schedule. Okay. We were at the IMN private equity event I told you in January. Then we were at NMHC, the biggest, multifamily conference in the country in Vegas, just a few weeks ago. And all these private equity groups we were talking to, and a lot of them are our lenders too. All these big groups are lenders and equity groups. We know them because we've done deals with them on the lending side. They all told us they're behind schedule for what they were supposed to deploy last year and this year. And a lot of them said that they expect something similar to 2020, where there's all this pent up demand, where, once there is a plateau of interest rates that they can underwrite to, this is the ceiling. Fed's not going to keep hiking them. They're going to have to start catching up and deploying capital. Okay. And so what that's going to do is, when you have more money coming into the market, it's going to create more competition. It's going to start to compress cap rates. And so we think that there's a good window right now. We can buy some of these deals at a really good basis before competition comes back. The other thing that's to our benefit with the financing and from a seller side is that, with these lenders, they're also behind schedule. Okay. Like I mentioned earlier, kind of what the interest rate is comprised of for the lender. It's comprised of the index and the spread. Okay. So, what's going to start to happen? We've already started to see this happen in the last 8 to 10 weeks with lenders we're working with on active deals. Lenders have started to reduce their spread. Okay. And once there's a ceiling on interest rates, it's going to happen a lot quicker, where they're going to start to reduce their spread or reduce their profit margin to reduce the all-in interest rate to incentivize borrowers to borrow money because they need to put out capital. Most of our lenders are debt funds. They're publicly traded REITs. They're paying out dividends. They're investors that have to deploy capital to get a yield and pay it back. This is what they do. It's their business model, is literally to deploy capital. And so we think that around summertime, you're going to start to see a lot of lenders come back, a lot of private equity come back, and then cap rates will start to compress. So right now, we see this as a really good window, to find deals that make sense. And so somebody might be saying, well, okay, you want to buy deals, but interest rates are volatile. How do you structure the financing? And so you can see here that a lot of people are saying, the sky is falling. You need to do fixed interest rates to protect yourself, fixed rate financing. We think it's very short-sighted, and we do not like fixed rate financing. Okay. And we've done 2 fixed rate loans since we started. We did 2 10-year Freddie Mac fixed rate loans, and they were 2 of our earliest deals, and we regret it. And frankly, it was a mistake because we just weren't experienced. We didn't know any better. And the reason it was a mistake is that whenever you do fixed rate financing, there's a trade-off there. Okay. So whether it's a bank, Freddie Mac, a debt fund, whomever, any lender who gives you fixed rate financing is guaranteeing your rate won't change. Okay. And so there's exposure for them, because if rates go up in the market like they have, well, then they're going to get hit with that, because they're guaranteeing you a lower rate. The way that they protect themselves and make their yield is they hit you with really nasty prepay penalties called yield maintenance or defeasance. Okay. And so we had this on a couple of deals that we bought early on. As an example, we bought a deal in 2019. It was a $17 million purchase price. We sold it in 2021. We had a $3 million prepay penalty right off the top. $3 million of cash right out of investors' pockets just goes to the lender just to pay off the loan, just to get out of it. Okay. So we actually had to hold that deal 8 months longer than we wanted to, because we were calculating the prepay penalty. We're like, we can't sell this thing right now because it's going to eat into our investor return. It's going to eat a huge chunk out of it. We had to hold it 8 months longer, keep renovating units, keep increasing NOI, just so that we could sell it, absorb the massive prepay, and still net out our investors over a 2x return. If we would have had floating rate debt with an adjustable or with a flexible prepay, it would have been a 3x return for investors. We were lucky the market was strong and that we could continue to increase NOI and still absorb that massive prepay. Well, in an environment like this, if you have yield maintenance or defeasance, then you may not be able to get out of that loan, because even if you get a little bit of a return upon the sale, you've increased the value, that prepay just eats up into your return. Okay. And your net return to investors isn't very strong. The same thing goes for refinances. Okay. If you can't pay off the first loan because the prepay penalty is so massive that it cuts into your loan proceeds, then you may be stuck in your initial loan. And so we don't like fixed rate financing because it really restricts your flexibility and your ability to adapt to the market, and to really maximize investor returns upon a capital event like a sale or a refi. And so, what we do is we like to do these floating interest rates. Because when you do floating rate debt, you get very flexible prepay penalties. Most of our lenders, they just want to see 18 months of total interest, meaning that you own the deal for 18 months, you can sell it, and you have no prepay penalty whatsoever. That allows us to sell it, maximize returns, 1031 exchange for investors, or we can do a refinance and return capital back to investors, or at least just take out the first loan, give ourselves a longer runway. And the way that we mitigate against those floating rate caps or those floating rate interest rates is we buy interest rate caps. Okay. So even if interest rates right now are at 8% or more, we can buy a cap down to like around 5% for the next 3 years. And when we maximize NOI by doing a value add plan, qualify for more loan proceeds and refinance, we can use the proceeds of the new loan for the refinance to buy another 3-year cap. Okay. So we really think that that's the best strategy. And we know it from our own experience. Okay. This is not like us speculating or theorizing. We feel like we made a mistake by doing fixed rate financing in the past. We don't want to do that again because it's not in anybody's best interest. And so, we feel like we can structure the debt right now so that it's very favorable and it's the best for these types of business plans. If you're doing like a 7 to 10 year hold of like a newer Class A building, then by all means, a 10-year fixed rate loan is probably best because you're not planning to exit that thing for 7 to 10 years minimum. Okay. But for what we do, our investors don't want that because a 7 to 10 year hold is going to be a very low yield. It's just a place to park cash. You're not growing the money very significantly for a Class A property. And then you can see here, we're seeing deals out there. So it's a needle in a haystack like it always has been. There's less deal flow overall, but there's also less competition. So it's all kind of relative. So in Phoenix, we were the top buyer of apartments over the last year. We were number 3 in Arizona the last 5 years. So we really do see almost all these deals before most people. And then in Dallas, we've been referred by all the top brokers in Phoenix, have referred us over and endorsed us in Dallas. And we're getting a ton of off-market deal flow. I just looked at our deal tracker, Bikron, over the weekend, and you and Brady have underwritten over 100 properties in Dallas since November. And so we're getting tons of deal flow, and we are starting to see a little more distress. We haven't seen widespread distress, in either market, but we're starting to see signs of it in Dallas. Like our first Dallas deal, they were distressed because they were coming up on a 3-year balloon payment next month in March, this week. And we had a bunch of LFI investors in that deal. So you guys are probably familiar. We have another Dallas deal that we're launching this week. And the seller is a prominent local Dallas syndicator with one of those mentorship groups that people have heard of. And he bought it in 2020. He had a 3-year cap, but it was a high cap. He didn't buy the rate down very low. And the broker told us he was highly leveraged. Okay. And so He's feeling the pressure of the interest rates, and investors are pressuring him to sell. Is what the broker told us. We got that deal at a very good low basis, completely off market, no competition. So because we're active, because we've been able to prove out our track record of being able to close deals, the brokers are coming to us with these good opportunities, because right now it's not about highest purchase price for these sellers. They want what they can get, obviously, but it's highest probability of execution, because most people can't even raise money right now. Okay, so we can still raise money. We're fortunate. We have a strong investor base, and we try to be transparent with investors so that they want to continue investing with us. It leads to good opportunities because sellers and brokers know we can perform. And so, we're still seeing good opportunities here. We're going to continue to buy deals because we're active buyers and active sellers. Okay, we bought 40 deals. We've sold 11. Right now, in the short term, it does not make sense to sell these deals. Okay, because we don't want to give a discount, because the discount works both ways, right? Because interest rates have gone up, buyers have less purchasing power, okay, which brings pricing down. Cap rates have gone up. So when you're a buyer, you want a higher cap rate. When you're a seller, you want a lower cap rate. Well, cap rates have gone up because interest rates have gone up. There's a positive correlation there. And so, as a seller, the longest deals that we've only owned them for, just over 2 years, 2.5 years is the longest deal we've owned. And so we don't want to sell these deals and give a discount to a potential buyer in the short term, because we're not distressed. We don't need to sell it. We'd rather wait another 6-12 months or so when interest rates do start to come down, which we think will happen next year. Who knows what happens. But even when the Fed stops hiking these rates, you're going to start to see cap rates compress. And when cap rates compress, values will go up very quickly. By that point, we will have maximized NOI and we'll have lower cap rates so you can get really good valuations, okay? Because when you want to look at the two biggest factors when it comes into these valuations for these properties, it's where interest rates at, where is your NOI at? Okay, that's how these things are really valued if you want to simplify it. And so in the short term, the next 3 to 4 months, 3 to 5 months, it does not make sense for us to sell these deals. Just because we can't get as good as strong returns as we could have, if we wait a little bit longer. On the buyer side, we feel like we can get good acquisitions, good opportunities here. And so that's kind of, where we're at. And then I will say too, there's a handful of deals that were 2021 acquisitions that we have paused distributions on. Okay. And that was just to be proactive. We're running this stress test and we're looking and we're saying, okay, we need to preserve liquidity and the cash reserves at the property. So we've paused distributions on a handful of 2021 deals. I know that we don't have any LFI deals with the group that were 2021. We started last year. And we do not plan to pause distributions on any 2022 deals. Okay, so again, we don't plan to pause distributions this year on any 2022 acquisitions, which would include any of the LFI deals that we bought with the LFI group. The reason we've paused on some of those 2021 deals is that we were still purchasing 3-year caps. We were still raising significant cash reserves, but in like summer to fall of 2021, we were buying a lot of deals. Nobody saw rates going up this quickly, so we weren't raising as much reserves as we were in 2022. Beginning of 2022, we started seeing what was happening. We started to adjust our underwriting. We were buying even lower caps. We were raising more reserves so that we have even more cash in place. And so just wanted to be clear with people that we're not pausing any 2022 acquisitions, and we've already paused a handful of 2021 deals. I mean, that's just, by the time we're pausing, it's because in our forecast, we're preserving as much liquidity as we can, right? So we're saying, okay, let's pause now. And whenever we pause distributions, that is not going to impact the overall return for the investor. And it's not like we're making money and investors aren't, okay? Because your preferred return protects you as an investor. And so those distributions are accruing. Okay, we don't make anything until we've given you 100% of your capital back, plus fully caught you up on your preferred return. And so that will all be paid out upon, if interest rates were to come down, we can start catching people up with special distributions. Upon a refi or a sale, we'll fully catch people up on distributions. And to give people an idea too, Bikram and I individually are the 2 largest investors in the entire portfolio. Okay, as far as actual dollars invested. I'm not talking about sweat equity, I'm talking about actual cash invested. Okay, so I'm the single biggest investor. Nobody has invested more of their own personal cash into our deals. Okay, so I truly believe in it. And if we ever have to pause distributions on those 2021 deals, then I'm getting impacted too for cash that I've actually invested in the deal. But that's kind of kind of gives you a forecast of where we've been. And Bikram, do you have anything to add to any of these points on this slide?
No, sorry, can you go back there, Zach?
Yeah, one sec.
Yeah, no, I don't think I have a lot to add there, Zach. I think you covered it mostly. But yeah, no, I think in the short term, as you mentioned, values are down, so it's a great time to pick up some good deals. And based on where the distress is in the market, I think over the next few months you'll see more and more deals come out that where sponsors effectively have to sell. But I think for us, it's a good time to buy properties. It's not a good time to sell. So we're kind of just positioning ourselves to make sure we pick up the properties at a good basis, do our business plan, and get out in 3 to 5 years with a good return for investors.
Yep. And so we can open up Q&A now, Chad, if you want to type it in or
Sounds good. Yeah, we've had a few that came in during your presentation, so I'll run through those real quick with you to start out with.
yep.
First one was, I think you've kind of spoke to this, but maybe you can reiterate. The question was, what specific adjustments have you made to your underwriting model over the last few months and why?
Yeah, great question by Kevin. So,
Mhm.
and I'll defer to you, Bikram. I have one thing I'll mention, and you can probably dive deeper. So, for all the deals in 2023 that we're looking at for both Phoenix and Dallas, we're assuming 0% organic rent growth in year one. Okay, so we're assuming no organic rent growth whatsoever. We always reference RealPage and CoStar data, which are the leading multifamily analytics companies that we have subscriptions to. And so in these decks, as some of you have already seen, we show investors what is the projected rent growth in year one for CoStar and for RealPage. What is their projected rent growth year over year on average next 3 to 5 years? And then we show what our assumptions are, and we want to be much lower than both of them for both year one and the average of the next 5 years. So that's one big thing. Just like in 2020 during COVID, we were assuming 0% organic rent growth. Anything else, Bikram? Bikram does the underwriting. So, what else have we adjusted?
Yeah, in addition to the rent growth, we're just raising a little bit more reserves than normal. I think the way we're kind of approaching these underwritings is it's very defensive. We try to allocate as much as we can to the CapEx budgets on the front end. So when we do our due diligence, we don't get shocked by the sticker price if we come across any deferred maintenance. We just reallocate, and we've been doing that for a while now. It's nothing new, but we're just being a little bit more cushion in that respect. And then from an interest rate perspective, instead of buying a cap, 1-2% outside of the money, we're buying caps that are pretty inside the money. So we're not going to get impacted by variable interest rate on these deals, as Zach has kind of mentioned. If the interest rate today or SOFR today is around 4%, we're buying a cap around 1.5-2% on our deals to make sure that there's no variability in our debt payments over the next 3 years during the term of the cap.
Great. Thank you guys for that. Lucas asked, what do the rent increases look like on Rise on Cactus? He didn't see it on the slides.
Yeah, good question, Lucas. So yeah, Cactus, we purchased it at the very end of September of 2022. And it typically takes us like 2 to 3 months to do the transition, start renovating units and get the data. So when we made the renovations case study, we didn't have a lot of data on Cactus, but I know that we started getting through those. I don't know if you have that available, Bikram, but we can email that to you. I know that we've been hitting and exceeding our projected rents. I just don't know how many units we've renovated on Cactus and what those look like. But I know that we'll have that in the reports that are going out this week. So you'll see that in the reports, Lucas, but the reason it wasn't reflected on the renovations case studies, we just didn't have a lot of data to report yet. But yeah, that was a 2022 acquisition.
Great. Next one relates to cap rates again and asking about what the entry cap rates are you're seeing on new deals, and then typically what do those change by with the value add improvements that you're doing?
Bikram, you want to take that?
Yeah, no, I think for the most part of the past 6 months, we're seeing cap rates between going in caps around 4 to 4.5 or 4.5 to 5, depending on the location and the market that you're going into. And keep in mind, these are, our numbers on T3 income annualized over pro forma expenses, and we typically budget higher expenses than normal. So you'll see a lower going in cap. I can use a broker's number and say it's a 5.5 cap with unrealistic expenses, but that's what we've kind of been seeing, 4 to 4.5 going in or 4.5 to 5 going in, depending on the market and how much value add there is on the deal. And then the second part of the question, typically how much cap rate does the value add improvements add to the entry cap? It's a good question. I'm not 100% sure, but our exit debt yield, typically it's around 8% in year three. So that's what we're trying to solve for. Around a 6.5 cap on year three stabilized is what we're trying to solve to for these deals.
Maybe Bikram, what they're asking is if, I know you won't know the exact number, but if you take the NOI growth that we experienced after the first 3 years and you were to divide it by the same purchase price we bought the deal at, do you know like how much that would
Yeah.
increase the entry cap? Take that
Yep,
same.
that's the yield on cost. That's around 6.5, sometimes hitting 7 on some deals, depending on where the property is located.
Yeah, and a lot of those deals we bought between a 3 to a 4 cap going in. So you're adding significant value. Randy asked, have you closed Highland Meadows? When should we expect first distribution? Yes, we did close Highland Meadows on February 9th. And we always tell investors we're going to start distributions 90 days after closing to be conservative, which would be probably like early May. In reality, we may start that sooner. We may start it in April, but we'll keep you posted. But yeah, we're right on track with the initial schedule that was listed in that webinar and that deck, and we closed that a few weeks ago. And Bikram and I were just in Dallas last week. We're there every 2 weeks now for operations meetings. So we had our operations meeting with our staff there. The takeover went really smooth, and we kind of hit the ground running, knowing that our plan is to renovate units quickly this year. So we already had everything prepped up. So like on a deal like Cactus, which I think Lucas asked earlier, on Cactus in September, we typically would test units the first couple months last year. We would say, okay, can we hit some pro forma rents without having to renovate units? And so we didn't go full speed right away. On a deal like Highland Meadows, we just finished 6 units, are fully renovated, and we just took the property over 3 weeks ago. We've already started on exterior paint. We're about to start renovating another 16 units in March. And so we have all of our foundational infrastructure built out in Dallas already. Our painter is actually driving out there. So our exterior painting guy, Dino, he has a big Sprinter van. He drove his whole crew out there with all their equipment. And they were just there last week, power washing, getting going on that. The staff is doing really well. And so yeah, that deal is closed. Distributions will start soon. Todd asks if distributions do get paused for like an individual deal. I think he's asking, does it affect the fund distributions on a pro rata basis? The answer is no. And so it's only been a handful of deals that we paused 2022 distributions on. The fund is diversified. And so it is not pausing distributions. I don't know if you want to add to that, Bikram, but seems like a pretty simple question.
Yeah, no, I don't think I have anything to add for that. Sorry.
No worries. So do you want to answer the next one, Bikram? It says, I understand that you prefer buying caps on the interest rate. How does it compare to having fixed rate debt and just paying the prepay penalty? Are they comparable or far apart? Do you do the analysis? Maybe you can talk about how, the caps are valued, things like that.
Yeah, so when we're buying these interest rate caps, they're essentially building in how much interest they have to pay on their end. So we're prepaying the interest along with a little bit of a premium for the broker and the cap provider. But by doing that, we're essentially locking in our interest rate for the deal at that time. So as Zach kind of mentioned, we're buying that down and keeping it low for the first 3 years. We have looking at whether or not a prepay penalty or paying the prepay penalty upon sale makes more sense. And the reality is, the only way that it would make sense is if interest rates go up even higher 3, 4, 5 years down the road when we're ready to sell versus buying the cap today. Because if the interest rates come down or stay where they're at, and we try to get out of the loan on the front end, what happens is we're gonna have to we have to prepay interest for 7 years on a 10-year term if we sell after 3 years versus prepaying 3 years of interest rate today. So that's kind of what happened with our fixed rate loan on Villa Serena. So that was a 10-year term, 5 years interest only. We sold it after 2 years. We had to prepay 8 years of interest when we sold that deal because that was a prepay penalty. If we had bought a fixed rate or if we had bought a variable rate loan with, say, a $2 million or $2 million interest rate cap on the very front end, that would have been a significantly less penalty when we sold after 2 years as opposed to doing the fixed rate loan. And the beauty of the interest rate caps is, if we do sell it within 3 years, we can still sell the cap and get some of the money back on the back end, as opposed to just losing the money on the front end. So we can reassign it and get some money back. And then finally, where it kind of helps us kind of look at the deals in a different manner. So when we're underwriting the full payment of the interest rate cap. We're not assuming it's going to cost us $50,000 and then we go spend $3 million on an interest rate cap. We're assuming $3 million of an interest rate payment up front. So it's kind of built into where we can get to on the deal level. So if we can get to an X purchase price with a $3 million interest rate cap, then that's what we can offer. We're not going to offer something way higher than that and then eat an interest rate cost on the front end just to make the deal work.
And on that point too, Bikram, you make a great point. You actually cannot model the prepay penalty for yield maintenance or defeasance because it's constantly changing. It literally changes every day with where the interest rates are at. And so anybody who tells you that they're modeling in to absorb the prepay is just, they're not being honest, because there's no way you can do it, because it matters. It's a matter of when do you exit and where are rates at that time. Because like Bikram said, when rates go up, your yield maintenance or prepay starts to go down. But if rates compress, then you have to pay more yield maintenance. Okay. So it can work against you, and you just simply cannot put it into an underwriting model and budget it out. Whereas if we're paying a fixed amount on the front end, and these caps are expensive. Okay. Like we're not making these interest rate caps right now are $2 to $3 million. So what we're doing is we're basically raising it on the front end as a closing cost, and we're biting the bullet on the front end. And if the deal still pencils with our conservative assumptions and knowing that we have this cost on the front end, then we feel confident knowing that our interest rate will not change the next few years, and we can get out of that loan at any point with little to no prepay penalty whatsoever. It just makes your projections more accurate and something that you can actually, extrapolate out. Whereas, when you have a prepay that you have no clue what it will be, then you don't know if you can actually get out of that loan when you want to.
Great. We do have one hand raised. I'm going to check on Kyle here and see if you had a question for sure. Okay, Kyle, I think I gave you the ability to talk. Do you have a question?
Oh boy, was that me? Dude,
Yeah.
I'm sorry. That was definitely a pocket butt dial thing, man. I'm sorry.
I didn't want to
question now, Kyle. Come on, man.
Case, so, no
hey,
problem.
I don't have a question, but I'm looking forward to seeing you guys next week. Come on, baby.
Yeah, there you go. No, we're looking forward to seeing you too, Kyle. It'll be good.
Yeah.
Coming by.
Yep.
Perfect. Let me check on Francis here. Francis.
Everybody's going to be scared to push the raising their hand button.
Yeah, exactly. Francis, do you have a question? Francis, it looks like you're muted maybe still. Yeah.
Yeah, I did not.
There you go. There you go. Oh, okay. Okay. Another one.
If anybody has questions too, Chad, and maybe you don't want to ask it in front of the group, or maybe you want to get on a call with us, like you guys can email us, email Bikram or I, and we'll answer your question via email, or you can set up a call with us. We'll get on a one-on-one call with you. Like the biggest thing that we're trying to show investors is that, we're in tough economic times, obviously, it's scary when rates go up, and we want to show investors that we're forward facing, we're transparent, we're accessible. Okay. So we don't want to ever create the perception that, we're hiding or anything like that, which is why we wanted to do this. We had this meeting already set up, but we just made this topic a couple of weeks ago because we think it's really important right now. And so, yeah, if you guys want to email us, I don't know if there's a way to send it to everybody here, Chad, but like our email address.
You can in chat. Yep. You can send it.
It says right now it's going to host and panelists.
Oh, okay. Well, you get it to us. We'll get it out to the group.
I'll type my email and Bikram's email, but yeah, if anybody wants to email us with specific questions, and then, as many of you guys probably have noticed, I don't know what other people are doing for their investor reporting for like sponsors, but, we've gotten feedback that we have some of the most detailed and transparent reporting, in the industry. And we're trying to, add as much detail to those reports as we can. So we show people, these are the cash reserves. This is where the interest rate cap is. This is how many units we renovated. And you're going to start to see, these next several months, you're going to start to see in the reports, the velocity of renovations increase. Okay. So if you're in some of these deals, like, I had a deal, this wasn't an LFI deal, but we bought it in January of last year and we hadn't renovated any units on it. And so one investor recently asked me, they're like, hey, how come you guys haven't renovated units? And it's because we were hitting our pro forma rents without having to renovate. Right. On some of these units, we were testing them. We'll buy a deal. We'll see if we can get the projected rent increase without having to renovate. And we were, so it didn't make sense to spend money, but now we're just trying to crank the renovations no matter what. So you'll start to see that we're updating. We renovated this many units. This was the increase, things like that. But yeah, if there's any questions or feedback that people have, we appreciate it. Thanks again. Go ahead.
Yeah, there was a quick one. Maybe you can answer real quick too about how many deals you have in the pipeline in Dallas. I don't know if that's a quick answer or not really, but maybe you
Yeah.
can make it quick since we are over 8 o'clock.
Yep. Yeah. Yeah. We have this one that we're launching this week. And then we have another deal under contract that we're going to launch in April. It's a smaller deal. But yeah, we have two. We have two right now.
Gotcha. Very good.
Yep.
So great. Well, guys, appreciate you coming on and sharing that. I think it's great to hear this and see the transparency. We really appreciate you sharing that with the community and everything else. You're right. It's a reputation business. So I love the fact that you're willing to come out and share with us where everything stands right now. That's great. We do typically jump into wonder.me after our meetings to do a little networking. I'm trying to see, oh, here, Steve sent me the link. I can copy it in here for you guys. This is an app that allows us to jump in and do some networking by topic that we've done several times after our meetings. Works out pretty well. Bicker and Zach, we encourage you to join if you've got the time. You're welcome to as well. Sure. Would be great. There might be some other Q&A. There's the link. Hopefully everybody can see it in the chat. If you click on it, the password's there to use as well. Once you don't close out of it yet, go over into it and then you can come back and close out of Zoom. But if you jump in there now, we will jump into some networking and you can ask other questions of the guys if they're going to stick around. So we appreciate that.
Yeah, no, I'll jump in there right now.
Awesome. Thanks, guys. We really appreciate it. We'll
Thanks,
be
guys.
talking to you more this week.
Yep, we'll see you again soon. Thanks, guys.
Yep. Thank you.